This video is a review of section 3.2, and so in this section we're going to look at business transactions and how they affect the accounting equation of assets equal liabilities plus owner's equity, and we're going to look at investments, cash transactions, and credit transactions. So a business transaction is an economic event that causes a change, either an increase or a decrease, or both, in assets, liabilities, or owner's equity. So every time someone buys something, so think how many transactions Target does in a day. Every time. And then you can understand why those are all computerized. But we're going to look at a couple simple examples here, and then we scroll down and we kind of take them through the equation. But just to talk about them for a second, a business is going to buy a computer with cash. Its cash is going to decrease, right, because we have to pay for the computer, but the business is acquiring a new asset, and so that asset is increasing. We record these increases and decreases in something called an account. So an account is something under assets, liabilities, and owner's equity. So there's a cash account, and there is an owner's equity account. And so why we do that is because we need to know what we have in cash at any point in time, or what our liabilities are at any point in time. So these are found in what's called an account. Let's see, accounts represent things in the real world, money owed to a creditor, like I said, or how much office furniture we have. Every business is going to do this differently. You know, like our little zip delivery is going to have 6 accounts. And you can imagine Target probably has 1,200 accounts or more. And so we're going to set this up however it works the best for that business. So Little Zip Delivery has assets here. They have cash. The book calls it cash and bank. I don't call it cash and bank because, of course, it's in the bank. I just call it cash. Something called accounts receivable. Computer equipment is an asset. Office and delivery equipment are as well. Liabilities, they have an account called accounts payable. And owner's equity, the account is always called the owner's name and then a comma and then the word capital. And we'll talk more about that later, but that's what that account is called. So what are accounts receivable and accounts payable? Accounts receivable means that we've sold something on account and we have given someone credit. It is something of future value that will eventually come back into the business. So it's a future asset. We record it as something that we assume we're going to get, so we use it as an asset. Accounts payable, on the other hand, are the amount that we owe or is payable to our creditor. So when we buy something on account, we buy like the truck example, we would put that into an accounts payable. So the difference is accounts receivable is us selling something and accounts payable is us buying something. So how do these transactions look? And every time we talk about something new, the book always breaks it down into 4 different things. They first list the accounts that are affected. They then say, what are these accounts? Are they assets? Are they liabilities or owner's equity? The third thing, they tell us if it's an increase or decrease to that account, and then we just make sure that the accounting equation is in balance, because that's the most important thing. What we do to one side, we need to do to the other side, and it must remain in balance. So the first transaction, that occurs for every business, has to. There has to be this transaction. The owner has to put money into the business in order for it to start. So every first transaction looks something like this. So Krista Vargas took $25,000 from personal savings and deposited into a business checking account in the name of Zip Delivery Service. Okay, so something like this always has to happen. So we're going to first identify the 2 accounts, and they're going to be cash, and they're going to be her owner's equity account. So Krista Vargas Capital. When we classify those 2, cash is an asset and Krista Vargas Capital is an owner's equity. What's happening? Are they increasing or decreasing? Cash is increasing, and so is capital. Therefore, the accounting equation is imbalanced. The left side is going up $25,000, and on the right side of the equation, it's going up $25,000. The second transaction here is Krista Vargas transferred 2 telephones valued at $200 each from her home to the business. So these two could be actually combined together, but for simplicity, we're separating them. So that's very common too for the owners to take some things from their home that they don't need anymore or don't use, and they transfer them to the business, but keeping in mind business entity and keeping them separate. So the 2 accounts, we're going to figure out in assets what we have. What would the telephones be classified as? In this case, they're classifying them as office equipment. And then the other account that's affected is of course, her capital account. Office equipment is an asset, and Krista Vargas capital is owner's equity. Increase or decrease, they are both increasing by $400 because each phone is worth $200. And then let's make sure that the accounting equation stays in balance. So we're increasing office equipment by $400 on the left side, and Krista Vargas, her capital account is going up. So both sides are equal to $25,400. Okay, so transaction 3 is the purchase of an asset with cash. Okay. So Zip Delivery issued a check for $3,000 to purchase a computer system. My little note over here is anytime you hear the word check, it's equal to cash. If I write a check, it's cash. That's the account that's affected. So the 2 accounts are going to be, we're going to classify this as computer equipment by looking at our assets. That's the most closely connected. And then we paid with a check, so we wrote it for cash. Both are assets, so they're both on the left side of the equation, and the way that that works is computer equipment is increased, but cash is decreased, so it's a net on the left side. So if cash is going down, now what's in that account is $22,000 instead of the $25,000, and now what we didn't have in computer equipment, we have $3,000. So if I add both sides up, they're both still equal to $25,400. So it doesn't have to be 1 from each side. It can be 2 from the asset side as long as 1 is going up and 1 is going down. Okay, so cash transaction, on the flip side of that, when a business purchases something on account is what it's called. When you purchase on account, you're doing that for credit. So that's going to be an accounts payable always. Conversely, if we sell on account, that's accounts receivable, but that's going to come up in a little bit. So we are buying a truck, kind of that same example that we had before, on account. So we know it's an accounts payable for $12,000. So our 2 accounts are delivery equipment and accounts payable. Delivery equipment is an asset. Accounts payable is a liability. They are both going up. So we're going to have $12,000 more of an asset, and now we're going to have $12,000 more of a bill to pay eventually. And they have claims to that delivery truck. Looking at our equation, we have $12,000 increase over here, but then we also have a $12,000 increase over here. And I'm not going to be able to do that math on my head this quick, but we know that both sides went up by $12,000. So we're good. Okay, just a couple more here. We sold a telephone to Green Company for $200 on account. I'm not a fan of this transaction because we don't normally sell. We're in the delivery business, not in the phone selling business, but they just want to show us some things. So we sold it on account. So we're going to eventually receive the money. So it's a future thing. So we're going to affect accounts receivable, and now we have less office equipment. So accounts receivable is an asset. It's a future value to us, and office equipment is an asset. The accounts receivable is going up because we're going to get $200 in the future, and office equipment is going down. We've lost a phone. We no longer have a phone. So here's our accounts receivable. And we're going to get $200 in the future, but now instead of $400 worth of office equipment, we only have $200. So nothing to the right side, but an increase and an equal decrease on the left side. Transaction 6, we issued a check for partial payment on the amount owed to our creditor. So this is referring to our purchase of the truck. And so now we're making a payment on that truck. So we issued a check. Check is equal to cash in partial payment owed to our creditor. So the accounts affected are cash and then accounts payable. Nothing to do with the truck at all. The truck is still of value to us of $12,000, but we now owe less money. And we had less money because we paid. So the two accounts payable is a liability. Cash is an asset. Accounts payable is going down. We don't owe them $12,000 anymore. We owe them $11,650. Cash is also decreased because we wrote a check. We have less cash. So both sides of the equation should be going down. Here cash is going down, and here the liability is going down. Truck is still the same value, so we're not going to change that at all. Some of you might argue depreciation, but that's kind of an advanced topic that we're not ready for. All right, our last transaction is the $200 that we sold the telephone for has come in. So that person, our accounts receivable, has been paid off. So accounts receivable is affected. And how did they pay it to us? Well, they paid it in cash, of course. So cash is affected. Both of these are assets. Accounts receivable is decreased by $200. They don't owe us anymore. And cash is increased because they did finally pay us. So this is one of those transactions where nothing happened on the right side of our equation. Two assets, one went up and one went down. And our equation remains in balance. So that's section 3.2.